Traders fail not because the markets are impossible, but because they chase momentum without any real rules. They see a stock moving, and the fear of missing out takes over. You felt it before, the heart racing, the hands itching, the tape flashing green, and suddenly you throw in your entire account, hoping it keeps going. That is classic amateur trading. The thrill, the adrenaline, the rush of thinking you're going to catch the next big move. It feels like opportunity, but it's actually the fastest way to wipe out your account. Professionals approach momentum differently. They treat it like a predator stalking its prey, not a friend ready to hand them a gift. They wait, they calculate, and above all, they respect the risk inherent in every trade. Jesse Livermore, one of the greatest traders in history, had a rule so simple it seems counterintuitive: never put all your eggs in at once. He didn't dive in head first. He added positions gradually, in fractions, not all at once. This is the essence of the 1/5 rule. You start with just 20% of your intended position. Then, as the trade proves itself, you add another 20%. You continue this process until you are fully positioned. It sounds almost too simple, but it's deceptively powerful. This fractional approach is what allowed Livermore to ride massive trends without ever blowing up, and it's what separates consistent traders from those who fail spectacularly. Here's the twist that most traders completely miss: confirmation. Amateurs jump in as the price rises, reacting emotionally, thinking momentum alone is enough. They ignore the tape, the volume, the subtle signs that institutions are behind the move. Livermore, on the other hand, observed everything: the pivot points, the shifts in market mood, the volume surges. Each incremental buy was a test. If the trade failed, his exposure was minimal. He could survive, learn, and try again. Imagine it in practice. A stock gaps up in the morning. The amateur, heart-pounding, goes all in, only to be stopped out moments later in panic. Livermore buys just 1/5 of his intended position. If it fails, he loses a small fraction, nothing catastrophic. If it succeeds, he adds another slice, scaling as confirmation unfolds. By the time he's fully in, the trade is validated by multiple confirmations, and his risk has remained controlled throughout. His reward, magnified, because he's not gambling, he's positioning with precision. This approach isn't just about mechanics. It's deeply psychological. Fractional buying keeps emotion in check. Each incremental entry is a checkpoint, a moment to reassess, to measure the market's conviction. It's a shield against overconfidence, against greed, against the emotional roller coaster that destroys amateurs. Many traders who think they're following a strategy fail because they don't understand that the market doesn't reward haste. It rewards patience and discipline. Now let's talk about pyramiding, because this is where even professionals can get tripped up. Pyramiding, the act of adding to winning positions, sounds perfect in theory, and it is, but it carries a hidden danger. Once the first entry starts winning, the temptation to accelerate the position can overwhelm discipline. Over-leveraging too quickly can turn a profitable trade into a disaster. Livermore understood this better than anyone. Each addition wasn't just a fraction, it was a carefully considered decision based on observable market evidence. He wasn't guessing. He was responding to proof. To implement this yourself, start with the smallest reasonable fraction of your intended trade. Watch the price, the volume, the tape. If the market confirms, add the next fraction. Each step should feel almost mechanical, not emotional. Repeat until fully positioned, but never rush. Control your exposure, because even the strongest trend can reverse. Another key factor is timing. Professionals aren't just adding positions, they're adding them at the right moment. The initial entry is just the start. Subsequent entries are synchronized with market validation. Volume spikes, pivot confirmations, and tape direction act as checkpoints. Ignoring them is what separates amateurs, who gamble and panic, from pros who manage risk and compound gains. By embracing fractional entries, watching for confirmation, and respecting risk, you not only survive in the market, you thrive. This is the core lesson Livermore imparted. Momentum is powerful, but only when approached methodically. The thrill of the trade is not in acting quickly, it's in acting correctly. You ride the wave, not by diving recklessly, but by stepping in cautiously, adding intelligently, and letting the trade prove itself at every stage. The beauty of this method is that it scales with your confidence and evidence, not your emotion. Every step in the trade is a decision, not a gamble. The 1/5 rule transforms the way you interact with the market. It teaches patience, discipline, and respect for momentum. And once you internalize this approach, you'll see that trading is less about luck and more about probability and preparation. Yet, the psychological traps are still waiting. Even seasoned traders can fall prey to impatience, greed, or overconfidence. Pyramiding, while effective, can lure you into thinking the market owes you more than it does. The lesson is constant vigilance. Check each step, follow the market's confirmation, and never let emotion dictate your entries. By doing so, you harness momentum, ride trends safely, and avoid the catastrophic losses that plague amateurs. In the end, momentum trading is not about chasing, it's about waiting, observing, and scaling intelligently. The amateur seeks excitement, the professional seeks evidence. You can feel the difference immediately. The panic fades, replaced by calm calculation. You're no longer reacting to the tape, you're reading it, respecting it, and letting it guide you. Follow these principles, master the 1/5 rule, and you're not just trading, you're thinking like one of the greats, positioning with precision, and controlling risk in every move you make. Momentum trading is deceptively simple in theory, but brutally unforgiving in practice. Seeing a stock breakout sparks an immediate question in every trader's mind: how much should I risk? The amateur answer is predictable: everything, all at once. Heart pounding, adrenaline surging. They throw their entire account at a stock, convinced that the next tick is going to make them rich. The professional answers differently. Calmly, deliberately, they decide to risk only a fraction of what they eventually intend to hold. That first fraction, 20%, is the opening move of what Jesse Livermore famously called the 1/5 rule. It's a small commitment, a way to test the waters, a calculated step into a river whose currents could easily sweep the unprepared away. After this first step, the real work begins. Watching the tape, observing volume, monitoring pivot points, and noting the market's mood are all part of the process. Livermore did not blindly add to positions, he waited for confirmation. The market had to prove that the momentum was real, volume had to support the price, and resistance at pivot points had to be minimal. Only then would he add another 20% of the intended position. Each fraction acted like a trial balloon, a way to probe the market without exposing the entire account to risk. This isn't guesswork, it's disciplined testing. You're learning from the market, not gambling against it. Consider the historical example of 1929. Livermore observed a stock on a runaway climb. The first one, fifth fraction, went in. Almost immediately, the market faltered slightly, causing many amateurs to panic and sell, locking in losses. Livermore did nothing reckless. He waited for confirmation. As the stock rebounded, he added the second fraction. Each subsequent increment followed the same pattern. By the fourth edition, he controlled a full position, but the majority of his risk had already been mitigated. His account didn't just survive the volatility, it thrived because he respected both momentum and risk. The mechanics are straightforward yet profound. First, identify a strong trend that has clear momentum and institutional support. Then, determine your total risk and divide it into 5 equal fractions. Buy the initial fraction and immediately set a stop loss to protect against catastrophic loss. Wait for the market to validate your initial entry, observing the tape, the volume, and the behavior at key pivot points. Add the next fraction only after this confirmation. Continue the process until your position is fully scaled, but never hurry. Each step is deliberate, each addition a carefully measured response to real market signals, not to fear or greed. Here's a counterintuitive principle that separates pros from amateurs. Sometimes the best move is doing nothing. Watching, waiting, and letting the trend prove itself is not laziness. It is sophisticated risk management. Many traders confuse activity with profit, believing that constant action equals results. Livermore understood that the market rewards patience, not impulsive aggression. In fact, in momentum trading, the ability to resist temptation and act only when conditions are validated is a hallmark of professional discipline. Even with the 1/5 rule in place, the psychological battlefield remains. Fear of missing out, the temptation to accelerate entries when a stock hits a new high, impatience with waiting. These emotions can sabotage even the most methodical system. Livermore was aware that controlling risk mechanically was only part of the equation. Controlling your mind, your impulses, and your reactions was equally crucial. The simple fractions become traps if you let emotion dictate the timing or size of your entries. By following this incremental approach, traders achieve 2 critical advantages. First, risk is controlled at every stage, preventing a single misstep from wiping out the account. Second, Reward potential is maximized because each addition comes after validation, allowing profits to compound while losses remain minimal. The 1/5 rule transforms momentum trading from gambling into a disciplined, evidence-based strategy, and it illustrates a timeless principle: the market does not respond to desire, only to proof. In essence, the 1/5 rule teaches restraint, observation, and strategic scaling. Each fractional entry is a lesson in patience. The market sets the pace, and the trader responds intelligently. By internalizing this method, you are not simply following a system. You are training yourself to think like a professional, to act when evidence dictates, and to manage risk like one of the greats. Waiting becomes an act of strategy, not hesitation, and every addition to the position is a calculated move rather than a leap of faith. But the story doesn't end here. The 1/5 rule addresses risk mechanically, yet the mind remains the ultimate battlefield. Greed, fear, and impatience can all undermine even a perfectly executed strategy. How do you overcome these internal enemies while scaling positions? That is the focus of the next chapter, where psychology and mechanics intersect. Understanding how to pyramid positions without letting emotion destroy your account is the next frontier for anyone serious about mastering momentum trading. The rules are simple, but the discipline required is immense, and the lessons are often learned the hard way. The beauty of the 1/5 rule lies in its elegance. It provides structure in chaos, clarity in uncertainty, and a roadmap to profit without recklessness. Applied correctly, it turns the unpredictable currents of momentum into navigable channels. You begin to see the market not as a roulette wheel, but as a series of validated signals, each step an opportunity to grow cautiously, steadily, and intelligently. Patience, observation, discipline, and fractional scaling. These are the pillars that sustain professional momentum trading, and they are what allow a trader to survive, thrive, and ultimately master the art of riding trends without ever gambling their account away. You've executed the 1/5 rule perfectly. The initial fraction is in, the second and third increments have followed as confirmation proved itself, and the trend is running strong. You feel a sense of accomplishment, a quiet confidence. Then it hits a high and stalls. Suddenly, two voices appear in your mind, each demanding attention. Fear whispers, "Take profit now. It might reverse at any moment." Greed, louder and more insistent, screams, "Add more! Don't leave money on the table." This is the battlefield that most amateur traders never recognize. They see only the price and their own emotions, reacting impulsively, losing sight of the rules that were meant to protect them. Professional traders, however, see this tension as part of the game, a necessary test of discipline and patience. Jesse Livermore often warned, "The money is made in waiting, not in chasing, and here lies the hidden enemy, psychology." Every incremental buy is not only a test of the market's momentum, but also a test of your own discipline. The first fraction is a scout, probing the market and gathering information. The subsequent fractions determine your overall fortune. A single misstep, over-leveraging in a moment of excitement, ignoring a predetermined stop-loss in a fit of greed, or adding based on emotion rather than confirmation, can erase weeks, sometimes months, of gains. The market is impartial. It rewards the patient and punishes the impulsive, often harshly. Consider a scenario: a stock has surged 10% in a single day. An amateur sees the move and panics, thinking it's too late to enter. The professional asks a critical question: was my scaling based on confirmation or FOMO? If confirmation exists, volume supporting the move, pivot points clear, institutional support evident, they add the next fraction. If confirmation is absent, they do nothing. This self-questioning is the professional filter, a mental checkpoint that keeps emotion from dictating action. It is not hesitation, it is discipline in action. Is where Chapter 1, Foot's cliffhanger about psychological traps, comes into full play. Even with the 1/5 rule in place, traders cannot ignore their emotions. The system contains risk mechanically, but it does not nullify fear or greed. The key is detachment. Think of each fraction as an experiment, not a full commitment. This first fraction is a scout. I will observe, learn, and react only to confirmation. I will not chase the rest. By mentally compartmentalizing each incremental buy, professionals prevent a single emotional impulse from contaminating the entire trade. There's a counterintuitive maxim here that often surprises new traders. The first fraction will either win or lose, but the next fractions determine your ultimate success. Treat that initial 1/5 as reconnaissance, not an army. Observe how the market reacts, Let it validate itself, and then scale your position intelligently. If it fails, your loss is contained. If it succeeds, the reward compounds safely. Waiting for confirmation can feel tedious, even frustrating. Boredom or impatience is common, but in trading, discomfort is often profitable. Professional patience is boring, and emotional control is uncomfortable, but both are the mechanisms that separate consistent winners from emotional gamblers. Every tick you observe without acting unnecessarily is a victory of discipline over impulse. Even with the correct mindset, success is not guaranteed. Tactical mastery, entries, exits, tape discipline, and reading the rhythm of the market remains essential. Without these skills, fractions can multiply losses instead of profits. Scaling positions without understanding the underlying mechanics, trend, volume, and pivot points risks turning what should be a controlled strategy into a compounding mistake. Ultimately, mastering the psychology of adding positions is about patience, detachment, and perspective. Each incremental buy is a controlled experiment. Each pause is a moment to reassess. Fear and greed are inevitable, but they do not have to dictate outcomes. By filtering emotion through confirmation, compartmentalizing risk, and treating each fraction as a test rather than a full commitment, the professional maintains control, maximizes profit, and avoids catastrophic losses. The battlefield is not only external, the charts and price movements, but also internal, within the mind. Emotional discipline amplifies the effectiveness of mechanical strategies like the 1/5 rule. Without it, even the most elegant system fails. By internalizing this lesson, traders learn that psychology is as critical as mechanics. The first fraction scouts, the next fraction scale, and the mind filters impulse from evidence. This mindset is the bridge between mechanical risk management and real-world profitability, preparing the trader for the tactical mastery that turns disciplined fractions into tangible gains. Numbers don't trade themselves. Charts, candles, and indicators are silent. They tell a story, but they cannot act. The real work happens through your eyes, your rules, and your understanding of the tape. Jesse Livermore understood this better than anyone. He didn't simply scale positions using the 1/5 rule. He mastered the tactical elements that made those fractions effective. Every entry, every stop, every incremental addition was deliberate, grounded in evidence rather than hope. He watched pivot points, monitored volume surges, and read the subtle messages embedded in the tape long before committing another fraction of his account. This combination of mechanical discipline and tactical precision is what separates professional momentum traders from amateurs who rely on gut feelings and blind optimism. Entry tactics are deceptively simple, yet the discipline required is immense. Never chase the market. The first fraction of your position, your initial 1/5, should be placed only after a confirmed pivot or breakout. Confirmation comes in many forms: volume supporting the price, institutional footprints visible in the tape, or the absence of resistance at key levels. Your stop loss should be logically set just below the pivot or the most recent swing low. Each subsequent fraction has its own stop loss, layered in such a way that your accumulated gains are protected. This isn't gambling, it's risk layering. You are not exposing your account blindly. You are controlling risk incrementally while positioning for potential reward. Consider a real-world scenario. A stock surges 5% in a single day, approaching a known resistance level. The amateur sees the momentum and impulsively throws in the entire position, convinced that the price must go higher. Predictably, the stock reverses, the stop is triggered, and the account takes a painful hit. Livermore, by contrast, would add cautiously, observing the tape, noting the volume and price behavior. Stops would only be adjusted when justified by market action, not by fear or greed. The result? His position survives the stall, profits are protected, and the next confirmed move can be scaled safely. The tactical protocol is straightforward, yet it requires discipline at every stage. First, confirm the trend using both tape and volume, never assuming that price alone tells the full story. Next, add each fraction at precise pivot confirmations, layering risk and reward intelligently. Adjust stop losses logically, not emotionally, based on the market's behavior rather than personal anxiety. Repeat this method consistently with patience and rigor. A simple maxim encapsulates the principle: each fraction has its own life. Respect it, or pay the price. Here lies the counterintuitive insight. Sometimes the tape tells you to do nothing. The best trades are often the ones you do not take. Waiting does not cost, impatience does. Many traders confuse activity with opportunity, believing that being in the market constantly is the path to profit. The reality is starkly different. Acting without confirmation or discipline multiplies risk, erodes gains, and undermines the carefully layered structure of your trades. Professional patience is neither passive nor lazy. It is a strategic act designed to maximize reward while minimizing exposure. Even with tactical mastery, a final challenge looms: exiting trades. Knowing when and how to scale out without letting greed steal gains or fear force premature sales is a paradox that even seasoned traders struggle with. You may have mastered entries, stops, and tape reading, but without a disciplined exit strategy, your gains can vanish. The final chapter addresses this, closing the loop and showing how the 1/5 rule, combined with tactical execution and psychological control, creates a complete system for momentum trading. In essence, tactical mastery is about precision, discipline, and observation. It is understood that every fraction is both an opportunity and a risk, that the tape communicates the market's intent, and that patience often trumps impulsive action. By combining entries, stops, and tape analysis with fractional scaling, you position yourself to survive volatility, maximize gains, and navigate the market with a professional mindset. This is where mechanics meet psychology, where rules meet intuition, and where disciplined action transforms momentum from a fleeting chance into a controlled path to profit. Adding positions is only half the battle. Scaling incorrectly, following the 1/5 rule, and confirming momentum gives you control over risk and sets up potential gains. But the real test, and the true measure of your success, lies in the exit. Professionals know this better than amateurs, yet it is often overlooked. Exiting a trade requires as much strategy, discipline, and patience as entering one. It's not about being lucky. It's about methodically taking what the market gives you without letting emotions sabotage your progress. While amateurs panic sell at minor pullbacks or hold on greedily in the hope of catching every last tick, professionals approach the exit as a system, mirroring their entries with careful scaling. Partial profits are taken at pivot points, trailing stops are employed on remaining fractions, and adjustments are made in response to the tape, rather than to fear or excitement. Jesse Livermore famously said, "Cut losses quickly, let winners run, but never ignore the tape." This principle captures the essence of the exit paradox. The first fraction you enter often dictates the psychology of the entire trade. If that initial slice struggles or violates your stop, the exit is swift, limiting losses. If it confirms and shows strength, subsequent fractions are allowed to ride, but always with protection through trailing stops or adjusted levels based on price behavior. Each fraction is treated as an individual entity with its own risk and reward profile, preventing a single emotional impulse from undoing the entire position. Consider a real example. Livermore once held a stock through a steep rally. The early fractions had confirmed strength, so he continued to scale in. As the price climbed, he monitored the tape closely. When he noticed subtle weakness, a slight drop in volume on upticks or hesitation near resistance, he began trimming fractions systematically. He did not sell everything at once, nor did he ignore the warning signs. By exiting in stages, he preserved his account, locked in profits, and positioned himself to capitalize on future opportunities. An amateur, on the other hand, would likely have either sold everything too early, leaving gains on the table, or held the entire position too long, only to watch the rally reverse and profits vanish. This final chapter brings together the lessons from the prior sections. Think back to chapters 1 through 3, the contrast between amateur and professional mindsets, the discipline of patience, the power of fractional scaling, and the psychology of adding positions. Now, in the exit phase, all of these principles converge. The 1/5 rule is no longer just a method for entering trades safely, it becomes a framework for exiting strategically. Your mental discipline, honed through waiting for confirmation and observing the tape, ensures that your actions are based on evidence rather than emotion. Tactical mastery of stops, pivots, and incremental scaling completes the cycle, turning a potentially risky trade into a structured, controlled profit opportunity. Actionable takeaways crystallize the system. Cut losses fast when stops are hit. Size positions in fractions according to the 1/5 rule. Wait for confirmation before adding. Respect the tape, pivot points, and volume, and exit in stages, locking in profits while allowing winners to run. These steps transform momentum trading from an impulsive, high-risk gamble into a disciplined, repeatable system. The final maxim encapsulates the professional mindset. Trade like an army, not a gambler. Every decision, whether entry or exit, is deliberate, coordinated, and evidence-based. You are no longer reacting to price. You are orchestrating your trades with precision, patience, and control. Even after mastering entries, scaling, and exits, the journey doesn't end. The next frontier is understanding market sentiment, the subtle currents that precede big moves, the behavioral psychology of institutions, and the signs that a trend is about to erupt. Reading sentiment allows you to anticipate momentum, positioning yourself ahead of the crowd rather than chasing it. This layer of analysis elevates your trading from tactical execution to strategic foresight, giving you the edge that separates professional traders from amateurs permanently. Ultimately, mastering the exit is the final piece of the momentum puzzle. It requires discipline, observation, and respect for both the market and your own psychology. Fractional scaling, confirmation, tactical stops, and staged exits work in harmony to protect capital and maximize profits. By internalizing these lessons, you are equipped to navigate volatility, avoid emotional pitfalls, and execute trades with a professional mindset. Momentum trading ceases to be a gamble and becomes a structured, repeatable, and profitable system, where every fraction counts, every decision is intentional, and every outcome is controlled by rules, not by impulse.